Let me tell you something. If you're a long-term investor, you are at some point going to watch your portfolio get sliced in half. That's not a guess. It's a statistical certainty. But here's the thing. What separates the really successful investors from everyone else isn't that they avoid these drops. It's that they understand them, they prepare for them, and they survive them. So how do you actually do that? Well, let's break it down. So here's what we're going to do in this breakdown. First, we're going to stare the harsh reality of market plunges right in the face and dig into what the historical data really tells us. Then, once we have that knowledge, we're going to build a clear, actionable game plan that's tailored to where you are in life. The goal is to not just survive the storm, but actually thrive through it. All right, first things first. We need to get one thing straight about investing. These huge market drops, they aren't a bug in the system. They're a feature. They're a totally normal, even if they're a super painful, part of building wealth over the long haul. You know, the legendary investor Charlie Munger said it perfectly. Think about it like this. Munger is basically saying these huge drops are a test. Your ability to stay cool, calm, and collected, what he calls equanimity, when everything is flashing red, is exactly what earns you the right to get those amazing long-term returns. It's a total gut check. And, well, as we're about to see, not everyone gets a passing grade. Okay, I want you to just look at this number for a second. -95%. Just imagine for a minute logging into your brokerage account and seeing that your investment in a single company has been, well, pretty much wiped out. So what company comes to mind? Some failed startup, right? Maybe a company whose time just came and went? Nope, that was Amazon. During the dot-com bust, Amazon stock cratered 95% from its peak. And we're not talking about some little dip here. This was a complete catastrophic collapse. Can you even imagine trying to hold on through that kind of pain? And yet, that was the price of the ticket to one of the greatest wealth creation stories ever. It just goes to show you, even the biggest winners will take you on one heck of a terrifying ride. Okay, so to really dig into this, we need to be on the same page with one key term, a drawdown. It's super simple. It's just the measure of how far an investment falls from its absolute peak all the way down to its lowest point. We're going to be using this word a lot, so just keep that in mind. So just how bad can these drawdowns get, and how often do they really happen? Let's get into the hard data. Based on a big Morgan Stanley report that looked at thousands of stocks over almost 40 years. And fair warning, these numbers, they might just shock you. Here it is, -85.4%. That is the median, the typical maximum drawdown for thousands of US stocks. Let that just sink in for a second. The average experience with a stock isn't some gentle 20% dip. It's a crushing 85% collapse at some point. So this isn't some rare worst-case scenario. For an individual stock, this is the norm. And get this isn't some quick, one-and-done flash crash that's over in a week. The median time it takes for a stock to go from its peak all the way down to the bottom is 2.5 years. Think about that. 30 straight months of just watching your money shrink. Okay, and here's the real kicker. More than half, 54%, of all stocks that go through one of these massive drawdowns never get back to their old high. So that thing you always hear, oh, don't worry, it'll come back. Well, for a single stock, that's pretty much a myth. And as you might guess, it gets even worse the deeper the fall. It's pretty straightforward. The further it drops, the lower the chance it ever comes back. For stocks that fall between 50 and 55%, about 3 out of 4 eventually make it back. But for the ones that get almost completely wiped out, we're talking a 95% drop or more, only about 1 in 6 ever recovers. So this all leads to a really critical question. The data is pretty grim, for sure, but we know some stocks do recover and go on to do amazing things. What separates the Amazons of the world from the stocks that just go to zero? It turns out the reason a stock is falling matters a lot. So visually, the whole thing often looks like this crazy V-shape. The stocks that fall the hardest often have the most violent bounces right off the bottom. But, and this is a big but, that bounce can be a bit of a mirage. According to the Morgan Stanley data, even 5 years after hitting rock bottom, the average stock in this group is still worth only about 80% of what it used to be. The bounce is big, but the recovery? Often incomplete. Let's make this real. With a tale of 2 crashes, NVIDIA and Foot Locker. Both of them suffered absolutely devastating 90+% drawdowns. But their stories could not be more different. NVIDIA's crash was what we call cyclical. The whole industry took a hit, but the company itself was solid. It recovered in less than 5 years and became a monster. Foot Locker, on the other hand, its decline was secular. That means its whole business model was fundamentally breaking down. Same brutal drawdown, but for completely different reasons. And that's why understanding why your stock is falling is just so critical. Okay, wow. We've just stared into the abyss of some pretty brutal data. Big drops are common, they last a long time, and they can be fatal for individual stocks. So the big question is, what in the world do we do about it? How do we actually build a portfolio that can survive this? And really, this is the question you have to ask yourself, because you will have your own drawdown story. The only thing you can control is how it ends. Your preparation is everything. All right, let's start with a really simple, practical guideline, the rule of 110. And look, this is absolutely not financial advice, but it's a fantastic starting point for thinking about risk. You just take the number 110 and subtract your age. Whatever number you get is a rough guide for the percentage of your portfolio you might think about having in stocks. It's a simple way to slowly dial down the risk as you get older. So let's take this idea and see how it works in the real world, decade by decade, and how your strategy might need to change as you move through life. All right, if you're in your 20s or 30s, you have a superpower, time. Using our little rule, that means you might have 80 to 90% of your portfolio in stocks. You can, and probably should, be aggressive and embrace that volatility, because you've got decades to recover from any crash. The name of the game here is simple: let that compound growth do its magic. Okay, now you hit your 40s and 50s, and suddenly retirement isn't some far-off idea anymore. This is the balancing act. Your stock percentage might drop to around 60 or 70%. You're still in it for growth, for sure, but you're starting to build in a little more stability to protect the wealth you've already built up. And this is prime time to be maxing out those retirement contributions. Now we get to your 60s and the whole game changes. This is the preservation phase. Your portfolio might look closer to a 50-50 split between stocks and bonds, with a nice chunk of cash ready to go. The number one goal isn't massive growth anymore. It's about protecting what you've built, making sure it outpaces inflation, and creating a steady stream of income. So after all this, after the terrifying data and the practical game plans, what's the big takeaway? What's the one thing you really need to remember? It all comes down to a really powerful way of looking at it. Think of it this way: a big drawdown isn't a fine you pay because you did something wrong. It is the price of admission. It's the cost of the ticket that you have to buy to get a chance at those amazing, inflation-beating, wealth-creating returns that stocks have delivered over time. You simply can't get the reward if you're not willing to accept the risk. And that really brings us to the final and most important question of all. It's not about finding the perfect stock or timing the market. It's a question about you. Now that you've seen the data, now that you have a plan, are you truly built to endure the brutal, gut-wrenching fall in order to earn the incredible climb on the other side? Because ultimately, your answer to that question, that's what will define your entire journey as an investor.